at the main story, obviously, today is the visits that we've been getting from the U.S. Secretary of Treasury and from the IMF-MD. But firstly, as usual, we're going to take a dart into the markets. Looking up, we want to thank everyone who's with us early this morning as we look at the numbers mainly in the markets. Now, let's take a look at what's going on in the Forex market. We are seeing that when it comes to Forex, the Kwacha is still on the worst progression that we have actually witnessed. It is still losing value, and I think we're on day number 76. Okay, day number 76 of the Kwacha losing value. It lost about 0.33% yesterday, while we are witnessing it lost against the Rand as well by 0.22%. So now looking at this, we're seeing about 0.8. We do see on the week that the Kwacha is down 0.88%. It has been a slow week of loss, but down 4.16% on the month. With about down 3.03% on the year in terms of the loss of our currency, which is signaling a lot of buying pressure. Now, part of this is also triggered by higher oil prices, along with the fact that we're still purchasing fertilizer in our markets. Now, going into the bond market, or the fixed income market, we have seen, again, that the bond market continued to move by 0.75% yesterday, mainly also because there was some secondary market buying in the bond sector, mainly because also secondarily because there was some positive sentiment that came into the secondary market from the the auction from last week. We did see interest rates coming down. They have been coming down, but they have come off the 23.63% down to about 23.39. So the positivity in our markets even finally gave a strong boost into the dollar-based bonds, and we actually have seen for the first time the USD index for bonds actually doing quite positively as well. So simultaneously, we are taking a look at the fact that we are seeing, as I said, positive movements in our bond market as well for our USD bond holders. Now, year to date, in terms of this, we're seeing about 2% performance year to date of our GRZ bond index, which is about beating inflation. So we're on a good track already, but we are seeing a negative performance of 1.26%, down 1.26% on the bond market, while we have seen interest rates come down by 0.25% year to date. So we are seeing a positive view of our bond market. And finally, let's take a look at the commodity sector. Which usually drives some news. We've seen 9,357 kwacha on copper. Copper is up 11.76% year to date, and up 0.17% from yesterday. Now, positively, what we're looking at from copper is we're seeing that we are seeing problems with South America, with South American data, where we are seeing that inflation data in Chile was up 13% last year, and that was the highest since 1991, while the world's number one copper producer is expected to be the only one of the South American countries to contract in 2023. That's what the World Bank projects. So we're actually seeing some weakness in Chile's economy, which will also probably signal lower copper supply around the world and therefore potentially higher copper price this year. Peru is also has inflation that soared to about 8.8% due to the stoppages. So we're seeing Chile having problems, a very bad year for President Boric. The 36-year-old progressive radical is having a very tough first year in office, and a lot of people are disaffected with what they're seeing in terms of his leadership. And then we're also seeing Peru breaking out into strikes after Pedro Castillo was kicked out, and they've got their new president, and they're having issues. So all this signals that copper supply around the world will start to slim down, while the rest of the world will start to do bigger. But we're also seeing oil at the same time doing quite strongly. This is what's probably pushing a lot of our FX rate downshift, is that the price of oil going up. Now, let me say this logically for many people. When oil goes up in price, it means that we need more dollars to purchase it. Therefore, the demand for dollars goes up because of the oil marketing industry, which then pushes up the demand, which then pushes up a lot of the currency, pushes up the value of a dollar in Zambia, because first people have to buy dollars before they can use those dollars to buy oil. So remember that dollar is the currency with which we purchase oil in. So we've seen oil up 0.47% yesterday, basically on good news of the Chinese holiday, and also there are new G7 sanctions that are set to come into force on Russia in the coming days. The US, Europe, and Japan are set to ban imports of diesel from Russia. Okay, you've heard me straight. Ban imports of diesel from Russia. And that is probably pushing up oil prices. Now, when you look at us as a country, what are we expecting? Projected pump price now is looking at about 25.14, somewhere around there with a margin of error. So 2.67% is what we're expecting the oil price, even with the tax concessions that have been brought into the market. So that's what we have to pay attention to when it comes to this kind of data. Now, let's take a look at what we're seeing in terms of gold. We are seeing as well that gold is up 1.93. Gold is at 1,931, up 0.21% yesterday on fears that a recession may be looming. So obviously everyone is on fear that we are on the cusp of a potential recession, and we saw oil and dollars go up by 0.21%, and in Kwacha, gold has gone up by 0.54%. So when you're seeing things like oil going up, by the way, I think I just missed this. Look at stocks that are obviously trading in oil. Those like oil marketing company stocks, they're the ones who've probably got their inventories that they're holding now are probably going to have a higher value if the pump price gets pushed up. So they benefit from this right pricing and higher pricing around the world. But gold, for those of us who want to be in terms of reserves, we're seeing that gold is up 12.36% on the year and up 8.99% year to date, mainly because of the performance that we're seeing. So good performance for those who want to hold gold in their portfolio. But remember, we said gold is what we call a wealth insurance asset. Whenever the markets are tilting downwards, we start to utilize gold as an option on our market. So that's what we're seeing in terms of the markets altogether. And now, in terms of the rest of the global economy, or what we call the economic calendar, which shows us some of the metrics that came out yesterday, we did obviously expect a little bit of data. It being Monday, there wasn't much in terms of data. And plus, remember that the Asian world has basically shut down mainly because of the Chinese Lunar New Year. So that's the main thing that we're seeing. That remember that we're still dealing with the Chinese Lunar New Year, and it's also the South Korean New Year. So you're not seeing much data coming out of these countries as well. But yesterday we did see that the Buba report came out of Germany. We did see new housing prices in Canada came in slow. They were on negative. So we are seeing a little bit of positivity in the housing markets. Consumer confidence data in Europe is down 20%, but it's lower than where it was. It's down 20 points, but it's lower than where it was before. So the drop is lower than what we expected. Plus, we're also seeing some interest rate data from the US, from the three-month Treasury bill auction. Sorry, the 3-month Treasury auction and the 6-month Treasury auction, which are both a little bit higher at 4.6%, which show you, by the way. So when you're seeing 3-month lending rates in America sitting at about 4.5% and 4.6%, add 20.7% to that, and that is what is expected from Zambia. So that is why our interest rates in our bond auctions is so high. And that's why the expectations have to be so high because of the lending rates that come out. Now, PMIs came out of Japan as well. Manufacturing PMIs dropped, stayed low from 40, stayed low at 48.9. But services PMI came up at 52. This is a transition, by the way, that we're seeing in these Asian countries. That we're seeing strong growing service sectors from their aging service sector economy, and we're seeing struggling manufacturing sectors, though Japan's manufacturing sector should be benefiting from lower exchange rates, from a weaker currency, which has been brought on by their devaluation. Now, let's take a look at data that we should be expecting to see today before we look at the 4 horsemen of how the world's economy is doing, and also before we look at the main story of today. The data that we should be expecting to read out today is that we're expecting public sector net borrowing from Britain. That data is expected to come out today. Composite PMIs coming out of Germany, with PMIs coming out of Europe, PMIs coming out of Britain, and PMIs coming out from different sides. Business confidence data coming out of South Africa is expected to see. CPI data, inflation data expected from Zimbabwe, who has 243% inflation as of last month and 2.4% month-on-month inflation. Look, the annualized inflation in Zimbabwe is not too high. They've only experienced one big, huge spike. So it's not continuous devaluation of their currency. They're still at about 2.4% in the previous month. We'll see what that comes down to. The inflation that we'll also be expecting, the data we'll also be expecting to see is PMI data coming out of America. So we should be expecting a lot of industrial data with a little bit of inflation data and price data on the market. Now, the major news stories as well. Obviously, we are seeing our visit that we're dealing with, and we'll come to that just now. But major news stories that we're expecting to see is that Sri Lanka is now hoping to complete its debt restructuring in 6 months. Confidence spilling out of Zambia that we are able to get a debt restructuring, or at least we are at work with debt restructuring, and the fact that we're seeing a lot of people visiting Zambia has now given Sri Lanka the confidence to see that they can possibly also now start to fix their debt probably in the next 6 months. And the main story, the main headline says that Sri Lanka is committed to meeting all its debt repayments and is hoping to complete debt restructuring negotiations in the next 6 months. And the central bank governor's bank chief, Mr. P.N. Nadala, I'm not even going to attempt to say his surname, said on Tuesday. Now, what we're also seeing here, we're also seeing in terms of the news stories coming out as well, is that oil is mixed as investors weigh Chinese demand versus U.S. outlook. Remember that we're waiting for the U.S. GDP data, which is probably going to signal, which might signal a recession coming around the horizon. So these are the major stories as well. In terms of it, and for the rest of the market, we are seeing main conversations around debt. Now, the first and big conversation that we're seeing here has got to do domestically with the visits that we got yesterday. I think that is the major story that we want to all focus on. It's the visits that we got yesterday from Treasury Secretary Janet Yellen and also from the IMF. And here are some of the highlights. Obviously, the main thing that has picked up on is Yellen urges Zambian debt restructure after talks with China. So she has basically cited that one of the main issues stalling the talks is that the Chinese delegation or the Chinese private sector are not comfortable taking a haircut because they're seeing some of the multilateral institutions are also not taking a haircut. Now, I think the biggest thing about the current visits that we're getting is that, one, it signals the battle between or the growth of regionalism. Part of what we're seeing is that we're shifting from globalism to regionalism. That's become the biggest signal around the world. And two, it signals a trend of what we call the Chimerica shift. And if anybody was with us, and I think in our end of year webinar that we did on investing, the two biggest investment signals that we did say is the transition from globalism to regionalism is a huge thing, and the transition from China America harmony to China America competition. These are two big shifts in the global economy that affect how debt is managed, that affect how supply chains are managed, and that affect how business is managed. But we'll come back on the other side, and I want to take you through some of the nuances of Secretary Treasury Yellen's visit and also what the IMF means, but on the other side of 60 at 60. So thank you to everyone who's with us. If you want to catch on the other side what this insinuates and what we should be doing to prepare ourselves as a country and what it means for your private portfolios, be it bonds, stocks, whatever you're holding, or maybe your business dealings, what does it mean? You want to take a look on the other side of the show. Also covering on the other side of the show, we will be continuing with our money matrix, where we did start our financial planning sector. Now we will be going into the wealth matrix. Those of you who are aged 30 to 39, you want to tune in because we did 20 to 29. We'll be doing the wealth matrix 30 to 39. Oil prices, copper prices, all behind the markets on money.
98. Email aquariteltd@gmail.com. Off Momo Road, opposite Zamanita. Aquarite, live a vibrant life.
60 at 60 at Money. 60 seconds of news headlines every 60 minutes on Money FM, your business radio. Powered by Money FM.
60 at Money at 8. Today, 23rd January 2023. The Nyimba Town Council allocated
.7.
All right. Welcome back to. So yeah, we're just having a little bit of a little jift here. Right. So I don't know if we're in good standing there. Sorry to everyone right there. That's a bit of a jump in the morning, but welcome back to this morning as we're getting into some of the main story for today is the fact that Secretary Treasury Janet Yellen has actually joined in with Christina Georgieva's visit to Zambia. So let's break this down. So at the end of last year, I did signal that I gave you 6 mega trends to watch out for in 2020. I gave you 6 mega trends that you want to watch out for going into 2022. Going into 2023, especially when you're investing in the stock market, you're investing in bonds, you want to see what's going on. You really want to look at what I call the 6 mega trends. And the 6 mega trends that I had cited, in fact, I actually added one to them. The 7th mega trend actually that I put is the financial 3D movement, the Chimerica rift, climate change and green financing, the green energy supply chain and minerals, the great Chinese transition from manufacturing to services, global monetary policy tightening, and regionalism versus globalization. These are the main issues that everybody should be paying attention to going into 2023. And I think we just have Vernon joining us now. Yeah, these are the main issues that we had going into 2023. And this is what I gave out last year. One of the reasons I keep pointing at things like China and America is because China and America are very critical to Zambia's economic growth story. And the reason is this. China has become the customer of our exports, especially copper. Copper being traditional exports in Zambia make up about 70% of the total export picture. And China is obviously the biggest customer of copper. It's the number 1 importer of copper because it's got the biggest electronics export market, and copper ends up in electronics and also building material. So cheap Chinese building materials was looked at for the worst Chinese construction projects. Remember that China also does global construction projects around the world. So China is our biggest customer. Also, the biggest thing also is that Zambia decided that when we borrowed money, we were going to half borrow from China and half borrow from America. And therefore, now when we had a default situation, we were going to bring the two biggest titans of the economy at a time when they're not getting along the best. They kind of do get along, but they're not as harmonious as they used to be. And now they're actually reflecting in our debt. So the Chimerica risk is actually reflected in the Zambian economy. So that's another part of the equation that we should actually take a deep look at. What is happening with the Chimerica rift, and what does it mean for us? So right now, today, we have two of the most powerful women in global finance visiting. I think the only one who's missing is Christine Lagarde. Otherwise, we'd have the trifecta of the most powerful women in finance visiting Zambia right now. What does this reflect for all of us? Well, the first thing that it reflects is that the Western world is trying to get Africa back. Effectively, they're kind of showing up like that guy who hasn't been paying attention to the lady of his life. Now, all of a sudden, another guy has pitched up with flowers, and he now is ready to take her out, and he's offering her marriage. Now, guy number one has all of a sudden gotten serious and realized he could lose his lady, and he has to come rushing in to fight for her. So that's what the story that we're seeing here is. So the reason I say this, and it's also got to do with the EV supply chain, is that electric vehicles are the future of the world. And the materials required for chargeable batteries and the transition to sustainable electricity, things like solar, because for things like solar energy to take off, you need good battery infrastructure. And for things like that to take off, you need a lot of lithium, which mainly comes from Australia, but there are new sources popping up around the world in South America and even in Africa. You need a lot of lithium, you need a lot of nickel, you need a lot of cobalt, and you need a lot of copper. Cobalt, copper. Where are the biggest two sources outside of South America who I've just been reporting are having problems trying to even get copper out the ground? Zambia and Congo. So this is why even recently we actually saw a deal, and I want to just quickly do a precursor here. We saw a deal signed between America, DRC, and Zambia regarding the improvement of the electric vehicle supply chain. So America has actually offered to do technical support to DRC and Zambia to help them build the capacity for electric cars. This is a contract where they're going to be doing research and development. They're going to be doing capacity building. They're also going to market DRC and Zambia to electric car producers in America. When, Vernon, have we ever heard of a deal like this? When have we ever seen that side of the world trying to be this helpful? Do you recall it? So because we're starting to see that for the first time, it is a signal that America is trying to compete for the affections of Africa. And Zambia is one of their golden children. So Zambia has been selected as that one that they're going to shine to Africa and say, look at what we've done to help this one. Come back this way. Come back this way. And what is the concern they have? Throughout the last decade, China has amassed influence in Africa. China has amassed such support. And at a time where America is competing with China geopolitically and they're sitting at the United Nations, here's what we found. Over the last decade, whenever China has taken a position on something in the United Nations, take a guess, Vernon. Take a wild guess who China has been voting with. I mean, Africa has been voting with. Take a wild guess. Between America and China over the last decade, who do you think Africans have been voting with in the United Nations? China. Of course. The one who gives you support is the one who we're actually now starting to side with. So the reality is America is getting concerned because when something hits the United Nations floor, 52 votes are backing China automatically. And now they've got to try and get that support back, especially when they're now in competition with China. Because remember, they were in collaboration with China because China was their supply center. Now they're in competition with China. They want to outproduce. They want to protect areas like Taiwan. They want to make sure that they can produce semiconductors. They want to be able to have that control. And the battle right now is whoever is going to dominate the electric car market is the one who's going to dominate the world because the EV supply chain is going to be the controlling influence. Here's the reality. For the first time last year, a Chinese electric car producer overtook Tesla. For the first time last year. Okay, so already the American brand is now lagging behind the Chinese brand, and that brings fear to America. So I'm just trying to give you this background. So remember what I said? Where do we get our EV parts from in this world? The battery parts. DRC, Zambia, partly Zimbabwe coming very soon with lithium, and there are possibilities that they could be lithium. So we are trying to position ourselves to be in the EV supply chain, and America has noticed that if China has such dominance in Africa, who do you think is going to have control of the minerals for EVs? And what we've seen when it comes to the pandemic is that we have seen that China will create their own vaccine, America will create their own vaccine, and they'll both compete to who has the proper vaccine that gets around the world. So this competition is now veering, and Zambia is smack dab in the middle. Minerals, debt, and the poster child for African restructuring. So over time, so here's been the issue. Over time, America has always pushed its agendas, okay, when it comes with its money. That's been the biggest concern of Africans, okay? They've pushed for democracy. That was good. They would say, okay, look, we're only going to lend, but you have to have free press, you have to have democratic standards, you have to have all these things. Now, these days, they're pushing funny things. I think, Vernon, we know what we mean by funny things, okay? These days, they've been pressing for funny things, okay? Things that we don't want in Africa, okay? We've gotten democracy and we've managed to get voting and stuff. Now they're pressing for funny agendas that our people are not comfortable with. And, one of the posters for that was Malawi. Malawi did not listen to what the Western world wanted. And what did? They cut off aid until they legalized a certain group of people getting married. And the rest of Africa took a step back and said, whoa, okay. So if this is how you guys are going to operate, we're going to go to the Chinese for loans. And as a result, okay, in the global economy, seeing that shift from Africa now shift towards China for financing, we've seen that China has gained such dominant levels of influence. When you're looking at hydropower station development, by the way, let's take a look at things like hydropower station development in places like Africa. The majority of hydropower plants are being built by Chinese contractors. The majority of infrastructural projects are being built by who? Chinese contractors. In fact, Janet Yellen landed in an airport, KK International, that was built by Chinese contractors and drove on a Chinese-built road coming into Zambia. So these are the concerns they're having, that wait, what influence do we have? You see, think about it this way. You've got turbines that are sitting in your power stations, okay? Companies like General Electric, who probably have 100-year servicing contracts on turbines. And your worst threat now is that a country like Zambia says, remove that turbine and fit in a Chinese turbine because we're doing business with them. Companies like GE lose huge servicing contracts for those, okay? Those are infrastructural contracts that big American companies would have, and they're at risk now of losing those contracts. So there is a competition. China is no longer that farming rice paddy state that people used to think about back in the 1980s and 70s, okay? China is now Shenzhen, the electric capital. China is now BDY, which has beaten Tesla and is making more electric cars than Tesla, okay? That's what China is. China is Huawei, all these huge companies, and now they're a threat. So America is now taking this opportunity in this time to now say, we need to establish ourselves back on the global stage. You know how I know this, Vernon? It's very simple. Second piece of news today, and I'm going to read this to you, that came out yesterday. And this just lines up the whole story for everybody to understand, is that an announcement came out yesterday saying this: U.S. Ambassador to the United Nations, Linda Thomas Greenfield, announced that she would be the second cabinet member heading to Africa, to Ghana, Mozambique, Kenya, starting when, Vernon? Tomorrow, as part of President Joe Biden's big push to engage with the world's second largest continent. What does that tell you, Vernon?
They have some interest in the second largest continent.
Basically, President Biden has recognized that if he's going to survive the next 10 years or the next 8 years, or if his administration is going to make a dent, he has to make sure that he has to start regaining influence. Now, obviously, the Treasury Secretary Janet Yellen stated that she insists her trip is not about competition. But let's read her statement very carefully. She said, we want to deepen our engagement, and we want to see the rapidly growing young population that needs opportunities and economic growth. Okay, that's what she says. Like, no, we're not here to compete with China. This is not about China. This is about us working with you. We want to see you grow. It's in our best interest. Then now listen to her next sentence. We have government programs and international programs that are oriented to help efforts build infrastructure, she said. And when we do that, we want to make sure that we don't create the same problems that Chinese investment has sometimes created here. Does that sound like a person who's trying to be neutral, Vernon?
It definitely happened. Trying to compete and have more of Africa's attention to themselves.
Exactly. So already, this now shows you that America means business. America and Europe have put together a $200 billion fund to help with infrastructure and development projects in Africa to rival China's already existing $177 billion. Now, putting China on the common framework and making them adhere to IMF standards, to global lending standards, and no more the back alley standards that they're worried about, now can slow down China's lending. Because that was rapid. China was lending at rapid levels, okay, to Africa. But obviously, it was taken advantage of too much, and it ended up going into debt. So now that's the situation. Now, the other side, let's take a look at the flip side of the coin. Now we're seeing the tension building up in our debt negotiations. Treasury Secretary Yellen said on Monday that it is critical and important to restructure the country's debt, and she believes that progress can be made after frank talks with key Chinese creditors last week. And the concern that the Chinese are having is, hold on. You want me to take a haircut, but what about these multilateral institutions? What about the IMF? What about the World Bank? Are they taking a haircut on their money? Because Zambia already owes them money. Are they taking a haircut? Because we don't want a situation where we're the ones taking a haircut and you're not taking a haircut. So that's what Chinese creditors are having. But she did say that Yellen calls on China to allow for headway as well to be made. And she also said as well that she reflects on concerns of the stalled debt talks, and she cites China and states that Chinese private investors are reluctant now to take haircuts. So this is a battle now. Our debt, this is why I always said the Chimerica rift is serious, because our debt is ground zero. It's a battleground. Okay, but the visits of Kristalina Georgieva and Janet Yellen signal the fact that the Western world has vested interests in making sure that Zambia is a success story. Because, Vernon, when you want to sell something to somebody, what do you need to offer them?
Something that they will benefit from themselves.
But what makes you comfortable, Vernon, to buy something? If somebody's making a sale to you, what is it that makes you comfortable to buy it?
Talk about prices, talk about the benefits of what I'm buying.
No, but what makes you comfortable with that purchase? What's the main thing?
Relationship with the person.
They've shown you it's worked for somebody else. That is the main thing. When somebody has shown you that something has worked for somebody similar to you or in a similar situation to you, all of a sudden you get more comfortable with that sale. It's called social proof. When a book, I urge everybody who wants to go into business, read a book called Influence, the Psychology of Persuasion by Robert Cialdini. Okay, I'll state that again. Influence, the Psychology of Persuasion by Robert Cialdini. He gives you 6 steps to getting a yes, or 6 important factors that you need to look at to getting a yes from somebody, or getting someone to agree with you, or getting somebody to work with you, to cooperate with you. And the 6 factors he points out are: 1, he says micro commitment, that people have made a micro commitment to something. Number 2, he points out liking. That we have likability to a person, and mostly people like people who have got common ground with them. They're cooperative with them, and they're complimentary to them. They say nice things to them. We like people who do that. Number 3, he says social proof. Fear of missing out. When people can see people just like them benefiting from something, they start to fear missing out on that benefit, and they start to do that. So what is Zambia? Zambia is the social proof of the G20 common framework, which if more countries like Sri Lanka, Pakistan, who are now in those hot zones now, Ghana, all these ones, start to see Zambia benefiting from signing to the G20 common framework, getting its debt reprofiled, seeing massive amounts of capital come in to its economy. if they start to see that, what do they start to become, Vernon? Envious. When they're envious of us, they say, bring us that G20 common framework, we'll sign it as well. And more of China's debt starts to sit under G20 common framework work. And now China now has to start lending in competition with America as opposed to lending the other way. So Zambia is a success story. Now, there's often this silliness that I find when it comes to, when you mention the West, media, and especially socialists, and I know I'm picking on them right now because, yes, I'm a capitalist. Sometimes I take digs at socialists. But the media and the social activists and the socialists will often have you believe that the worst things about you are going to be the West because we were colonized by the Brits. I want to explain to Zambians now, there is no more West and the East, okay? There's no more West. We're no longer on the side of the East because the West is the enemy. There is the developed North and the indebted South. That is what you need to understand. The world is no more East versus West. It's North over South. And we are the mineral basin for the development of the North. We are the indebted nations to the developed financial systems of the North. Okay? So the best way is not to go around picking sides. That is the silliest way to handle something. The best way we can do something is to play the middle. Okay? And that is what we've been doing. Allow China and America to compete in Zambia. You know what happens when they do that? They bring money to this country. That's what happens when we do that. So let's not go around. And I know there's something about our generation. Everyone is just this pro, I'm anti the West, I am the East, I'm anti. You're silly if that's what you're doing, okay? Because you're picking a side. You're broke. Both of them are rich. Don't go around playing rich people's fights. It's like when we used to argue about who was the better rapper, Jay-Z, Nas. You know, used to argue that stuff. Like people would be viciously angry. Jay-Z and Nas are both rich. Okay, I don't know what our issue is. They're both rich. So what we need to do is play both sides and allow them to compete by leaving money on the table, putting capital into our economy, pumping it in and allowing us to then benefit from it, putting harsh terms. You know, you can now look at America and say, if you don't like our terms of what we want for you when you invest, if we say X% of your companies that come into our country have to have a Zambian partner, okay, if you want to start a mining venture or a business venture or a factory, we need to see a 30-40% Zambian shareholder. When they say, no, we can't do that, that's not good, we're not acceptable to that, we can now say, well, maybe China is. And you know, that adds that threat. That's that threat component. Now we have leverage, Vernon. You know, the best way to get leverage in anything is having options. If you have no options, you have no leverage. But if you have options, you have leverage. So China and America competing for Zambia gives us leverage. And finally, if we have good negotiators, we can get good deals. We can get good investment deals. We can get good trade deals. We can start to actually do business on a better footing. But we should not pick sides. That's the key. Don't pick sides. And I'm going to leave that to that point. Now, obviously, the IMF is also here to crystallize all of this. And I'm using the word crystallize, knowing the name of the IMFMD, but crystallize all of this in all of this. And there's nothing nefarious. I really want to look at everyone and understand this is not nefarious. This is just how business is done. Okay? If you're in the business sector and you make money out there in the world and you're not just living in a world of imaginary social media, social activists, because when you're on Facebook, you have to be an activist. Okay, that's what everyone does. Because you're not productive. If you're not an industrialist, you become an activist. And because most people are being groomed to become activists, the main thing you want to look at is how to get business. And I'm going to try and read to you Robert Greene's from Robert Greene's 48 Laws of Power. Okay, and there is the law of maintaining your independence. And he says, never pick a side. In fact, the actual thing says, maintain your independence at all costs. Allow you to play people off against each other. When you hold back joining a cause, you create a sense of respect because you appear untouchable. Okay? That is how we need to handle these two. Allow them to play this out, but do not, and always be in play. And it says, do not commit to anyone. That is law number 20 of Robert Greene's Laws of Power. Do not commit to anyone. We do not commit to the West. We do not commit to the East. We stick to economic cooperation. And I hope the leaders of this country adhere to that. Okay. Everyone is now saying, oh, no, there's so much presence of the West coming in. I don't see so much presence. I mean, China's had full out uninterrupted presence in Zambia. So it's about time we balance this equation out. Okay. Let them compete. The ground will, I know the old saying is that when two elephants fight, the ground will suffer. In this stage, the ground will get fertilized. that's what we'll see. The ground will get fertilized. And it's up to Zambians to be it's up to Zambians to play this smart. Play your portfolio smart. Play your businesses smart. Okay? That's what we should be doing. This is the time as Zambians to know that you can do business with both China and America. If you have a product that's needed in both countries, you can actually do business on both sides. And the Americans have learned their lesson that you can't keep pushing your agendas into people's countries, your social agendas into people's countries, because they can turn to China. That's the biggest fear that they have. And that's the benefit that we have from all of this. But I want to tell everyone now, what does this mean for your savings and investment portfolios? There is a bit of stalling that's happening here. So will we meet the Q1 deadline to get our credit reprofiled? Remember this. For an American to invest in Zambia, okay, I think this is the easiest way to look at it, Brennan. For an American to invest in Zambia, they will expect LIBOR, which is risk-free, which is the risk-free rate, the basic risk-free cost of capital, plus they will expect, LIBOR, which is the risk-free cost of capital, London interbank lending rates, plus the country default premium. The current country default premium, according to NYU Stern, is 20.71%. So LIBOR is currently sitting at 5.12%. So an American is saying, for an investment to be good in Zambia, it has to give me more than 27.1%, more than 26.21% return on investment. That's what an American is saying. Whether it's a government bond, whether it's a stock, anything, it must give them 27% return on investment. Okay, effectively, that's what they say, 26 to 27%. So now at this point, and 20.71% of that 26, 27% is just the debt problem. The fact that we're in default. The country risk premium comes down, okay, the moment your debt is reprofiled. And now you're looking at maybe a country risk premium of 7%. An American investor starts saying, well, I'm more comfortable getting, all I need is a 12% return on investment to invest in Zambia. Now you start seeing more capital, more projects, more money being financed. You want a power station, people are more likely to get it because now looking for only a 12% return on investment as opposed to a 27% return on investment, because building a power station in Zambia and selling it to the locals who are only paying 6 cents on electricity while the mines are paying 9 cents, while the export market is paying 11 cents, doesn't make sense to an offshore investor. But when you start to right price your electricity and also you start to have a lower risk profile, then somebody comes in and says, we're setting up a solar station. We're setting up this. We're setting up that. We're coming to invest in your grid. We're coming to invest in that. Or we're willing to partner with ZESCO to invest in a grid. You see where the benefits start to come of getting this whole debt renegotiated. So for now, you might see the cost of capital struggle to come down a little bit. Bond rates will stay elevated. That's how you can get oversubscribed bonds. People rolling over their bonds and still, in fact, expecting higher interest rates on their bonds. So offshore investors are not going to be participating in our market. Once offshore investors participate more in our market, interest rates start to come down. So here's how you're going to play this year. H1 of the year, first half of the year, you use your bond markets because you got higher interest rates there. When you start to see bond interest rates plummeting down, that is a signal, people. That is the signal. I always say a bond rally precedes a stock market rally. So the signal to start going into your stock market portfolio is to see bond interest rates coming down. So when you start to see auction rates coming down, secondary rates coming down, bond prices going up, it's time to start switching to the stock market. Because that means that capital from the banking sector is about to get a lot cheaper. Capital floods in. Let me give you a simple example. When President Hichilema got voted in back in Q3 2021, $200 million worth of capital came into our bond markets, into our financial sector. So offshore investors from JP Morgan, all these other things, reprofiled our debt and said Zambian bonds are a buy. And they issued out $200 to $300 million that was purchased in Zambian government bonds. As a result, the FX rate came down to 16. Government bonds went rallying through the roof. The price of things did very well. And in fact, those investors who put $1.2 billion worth of government, bought $1.2 billion of government bonds in quarter 2, 2021, actually ended up making $800 million on their investment in just a matter of weeks, simply because of the secondary repricing of those bonds and the FX rate. So what you're looking for is that, one, you'll be looking to try and see a much stronger picture of what inflows can do. So once you get those inflows, interest rates on bonds come down. When interest rates on bonds and treasury bills start to come down, it means banks now put what's called the risk-free lending rate lower, because risk-free lending to banks is lending to the government. That is risk-free lending. So if risk-free lending interest rates become lower, then Vernon, all they'll say to you is, Vernon, we're going to put a risk premium on you. We're going to say that whenever I lend to Vernon, I'm going to add 20% risk on top of that. Vernon has a 20% risk premium. So in other words, if the risk-free rate is 18.6%, then the rate I'm expecting from Vernon is 20% above that. So Vernon is going to pay 38%. But if the risk-free rate starts to come down, okay, from 18 to 10%, that means Vernon's rate goes down from 38 down to 30%. You see that? So now all of a sudden, and now when you're calculating your loan becomes more affordable. The interest repayments become less. So you're starting to see that more capital will start to push out into the economy. And that's what we're hoping to try and see. There's a simple analogy we had put down called populism versus professionalism. Okay? And this is just something I wanted to it's a look at something that we had, but it's just something I wanted to pay attention to. If you look very quickly at, and this is about lower interest rates and more capital. When President Mwanawasa got our debt reprofiled, what did we see coming straight after that? We saw massive amounts of capital coming into Zambia. And we also saw that interest rates, lending rates started to come down. More capital went out. So here's the reality. I'm going to compare President Mwanawasa to President Lungu. Okay, it's a very simple comparison, and I know people can take it very dangerously, but I want you to look at this from something specifically to do with money supply growth. The two presidents who are the most responsible for the growth of the Zambian money supply, the amount of money created, are both President Mwanawasa and President Edgar Lungu. Okay, under President Mwanawasa, the money supply of Zambia grew by 209%. In other words, the amount of money in circulation tripled under President Mwanawasa. Okay, just under his, from 2006 up to 2011. I'm looking at the second term. Under President Lungu, the money supply from 2016 to 2021 also almost tripled. It grew by 180%. So here's what happened. Under President Mwanawasa, the GDP, the real GDP, grew by 60%. Under President Lungu, the real GDP only expanded by 10%. Why is this? Because when more money was created by the central bank under President Mwanawasa, you know what happened? That money went to the businesses. Okay? President Mwanawasa held a contained budget. He made sure he ran surpluses. And when he ran deficits, he ran them very slim. He ran a tight budget. So there was only an 81% expansion of government bonds and 163% private credit almost tripled under President Mwanawasa in that 5-year, 2006 to 2011. So what does it show you? The money supply was channeled to the private sector under President Mwanawasa. Okay? Now, under President Lungu, the money supply went to a 975, you're going to hear me very correctly, a 975% growth of government bonds. In other words, he borrowed through the roof. All the money that was being created by the central bank basically went to the government. Okay? It just went to government debt. And the credit only grew by 97%. So under President Lungu, the money supply growth was channeled to government debt, while under President Mwanawasa, the money supply was channeled to private credit. And what happens when money supply goes to government? The economy grows slowly. When money supply goes to the private sector, the economy grows fast. Salaries grow fast. Employment grows fast. Okay, that's what we're looking for. We're looking for a Goldilocks situation as a country, and that's what reprofiling your debt can do. It allows you to start to get growth. under those circumstances. And that's where I really wanted to put a lot of this going in today. I don't know if you have any other comments, Vernon, before we move into the wealth matrix today.
I was actually looking forward to the wealth matrix myself.
Okay, so with everyone there, you understand now how to play the market. Play your bonds first. Second half of the year, you'll be able to get into your treasuries. Now, let's take a look at the investment. Remember, we were covering investment planning by age. So right now, and to everybody who's watching, if you are and if you're listening, take out a notepad. Remember, Ebbinghaus's forgetful curve. If you don't write something down in 72 hours, you will forget it. If you do not write something down within 72 hours, you will forget it. You're likely to have a problem with it. So let's talk about this. We talked about being in your 20s. In your 20s, you should be looking at, your money grows the strongest. Money put in grows the strongest. So you should be looking at almost every 300 kwacha that you're targeting into the market when you're in your 20s. Okay, that is what will get you towards the end point. You're trying to, if you're planning on retiring by 65, every 300 kwacha or so that you invest in the market consistently without fail, and you're just doing that all the way up until you turn 65 at an average or an expected rate of return of 8%. That's what we often look at, because bonds have managed to do that over the last 21 years of 8%, will probably get you as close as you can be to about 700,000 to about $1 million. So that's what you're looking at. Almost every 300 to about 350, or let me even say 400 kwacha. Let me put it this way. When you're investing in your youth, 400 kwacha goes a long way. Okay, so that's what I want as many people to be able to focus on in that way. That's what kind of secures your growth, your investment to be able to pass $1 million. So now let's take a look at what happens to a person in their 30s now trying to manage themselves. And what does it mean? So remember, we're looking at 5 components of the investment planning matrix. What is the theme of your investing? What is your advised allocation of time? Your advised allocation of money? What investments should you avoid? And what investment themes and pitfalls should you also try to get away from? So to everyone who's listening, please give me that writing emoji, because I want to know that you're taking notes, people. I want to know that you're taking notes, because this is something that we're doing at the beginning of the year. Now, the purpose of all of this, remember, is to say, where am I? Where am I getting to? So this, where am I? You ask a question. Am I behind? If you're behind, then your goals for this year and the next couple of years is to catch up. If you're ahead, then your goals, if you're already caught up, your goals are to prepare for the next decade. What should you be doing to get to the next decade? So let's talk about 30 to 39. When a person is 30 to 39, we should be talking about a portfolio somewhere between 20 to 370,000 kwacha worth of wealth. And I'm talking about your liquid wealth assets. That's what we should be seeing. Okay, if you're 30 to 39. So if you're 20, you're looking at, that's where you should be when you're crossing 30. And this is what we should be seeing in terms of your wealth. Now, your wealth multiplier has dropped. Remember, in the previous one, we were saying the wealth multiplier was somewhere at 58 times every kwacha that's invested. Now we're seeing 18 times. Okay, so it's losing gas, because time is the number one factor of investing. Okay. When you're getting into at age 30, your average kwacha invested has a 28 times wealth multiplier. In other words, at age 30, when you invest, that if you continue investing from age 30, you should see about 28 times wealth multiplier on your money in terms of compound interest, mainly because of compound interest, because stock prices grow, they pay out dividend, bond values grow, they pay out dividend, housing markets grow, which pay out rent. So the fact that these assets are growing, every million kwacha in retirement you want in your 30s will require you saving and investing about 735 kwacha. Okay, so we've gone up. It's almost doubled. Here's a signal I want everyone to remember. Every year you delay investing increases the amount you need to be saving to invest by 15%. Every year you delay it. Okay, so this is why you have to start. No matter how small your money is, you have to start. You have to actually start putting money into the markets as early as possible to build your retirement portfolio. At this point, you should be saving and investing 20 to 25% of your income. Okay, and your savings is much more important. The amount that you're putting into the market is much more important than the return on investment that you're trying to pursue. Okay, that's a very important factor. So, and if you pass 500,000 kwacha in net worth in your 30s, mind you, I've seen quite a number of people already pass this number. I mean, this is what you see. If you pass 500,000 kwacha of net worth, then improve your investment sophistication. You should be looking at, but focus on transitioning wealth. Focus on transitioning your wealth from consumption to focus to transitioning to something called wealth customization. So at the beginning in your 20s, you were just trying to save and invest. You took money, you were throwing it into a unit trust. That's what you were doing. That's all you were doing to try and build yourself. Now what you're trying to do is you're trying to invest. You're trying to customize your portfolio towards yourself. So in your 30s, you should be asking the question, is my portfolio now customized to my journey? Where do I want to retire? In your 20s, I'll tell you standard retirement ages, 55, 60, 65. Target those. This is your saving. Now you're thinking, what if I wanted to retire at 53? What if I want to retire in 15 years? What if I want to switch towards doing this? These are the questions you start asking. Because when you're in your 30s, you're getting towards that 35 point. I say life happens in multiple stages, Vernon. 0 to 15. 0 to 15 is you just growing up. You're getting your body, you're getting in shape, you're trying to figure out things. 15 to 35 is your first step into life. Maybe you're getting to college, you're getting your first job, your heart breaks for the first time. Like real life events are starting to happen to you now. Okay, as an adult, you're losing things, you're struggling with things. Independence is a fight. Okay, that's 15 to 35 is lessons learned. 35 to 55 is where now you are supposed to be building yourself. Your legacy, your legend, your lineage is going to be built between age 35 and 55. So at this point, you must even customize your money to be doing the same thing. So what do you want to try and allocate your time in? At this point, when you're in your 30s, you need to be on a career path, not job hunting, on a career path. In other words, the difference between jobs and a career, jobs are a set of tasks that you go and do in a day. A career is a path of your profession that you are on, and you're on a trajectory now. You know which path you're going to, and you have seen where the destination is going to be. At this point, whether you're an entrepreneur, whether you're employed, you must be on a career path. So your 30s, we must be talking about what is the career destination you should be looking at. At this point, this is your last chance to take a big chance changing. You're not going to try and change your career. I know people like say it's not too late to change career. Listen, trying to change careers in your 40s is dangerous, people. It's not easy. It's not easy, people. So this is the 30s. At this point, also, you need to start having a work-life balance. Because if you overwork yourself, you unfortunately harm yourself health-wise, mental health-wise, social health-wise. You don't want to be harmed there because those are the things you're working for. And also, finally, you want to enjoy some of the milestones in life when you're 35. You start to look at life a bit more philosophically. You start to enjoy getting past 30. That's a big birthday. 35, your child is born. You're getting married. These are the big steps of life. So you want to enjoy them, but not become too debt-riddled. Where do you want to put your money? Invest in risk management policies. At this point, you need to now start covering risk. You need to start investing in life insurance. Start looking at where to have these things as well. Personalized. You also need to start investing in your post-retirement health, your post-retirement healthcare as well. So this is where you need to start putting aside money so that your healthcare needs can be met in your 50s so that you don't make it too expensive. You also need to personalize and customize your asset allocations for your risk preference. It's not just about numbers anymore. You should have a risk preference now and therefore be able to capitalize on it. Also consider where can you and I know people don't like this word because we're in a poverty country who likes to collect, but where can you avoid tax a bit? Where can you lean away? What investments, have got less tax? Just when you're thinking about things, when you're running your business, what options? If you're an entrepreneur, maybe put yourself on a gratuity, okay, every single year, because gratuity can be paid to you tax-free. Put yourself on a salary, then put yourself in a gratuity so that you can save some money tax-free. So what are the tax-free options? What are the loss harvesting you can do? Finally, let's just quickly look at what you should avoid. Don't rush into, don't be in a rush to avoid paying down low interest debt. You can do that. You can hold up. If you have low interest debt that is below the MPR rate, maybe you're a bank employee who has a mortgage, stretch that out a bit. Okay, so that you don't have to stress yourself cash flow wise, so that you can deploy your assets to growth. Simple thing you just want to measure is what's the growth rate of assets versus the interest rate you're paying. If the interest rate on a loan is 40% that you're paying and assets are only growing at 20%, pay down your loan. But if the interest rate on your loan is 5% and assets are growing at 15%, maybe you can pay up the assets. Okay, so that's what you can start to try and do. You still have a strong wealth multiplier, so don't make that mistake. Don't rush to the callings of having a big lifestyle. Stop trying to outsmart the market, because time in the market is better than timing the market. And avoid trying to make insurance investments. Insurance is about risk management. And I know people don't like that, especially in that industry. But the point is, insurance is more about risk management and about preserving your wealth than it is an investment. And I know people will try and tell you that, but I'm telling you the best thing you can do for something is to invest towards it and then keep insurance as a cover for eventualities. Okay. And I've seen this with, let's say, savings plans for whether it's education or anything. Trying to insure it can be a problem. And finally, Vernon, withdrawing money from your accounts, from your pension accounts, let's say when you're switching jobs, because in your 30s is when you switch jobs a lot. Okay, now you're valuable, you've got the experience, you're headhunted sometimes. Withdrawing money from your gratuity and investment is a mistake. We've all done it before. Don't do it. It's dangerous. Pension-backed loans are dangerous. Rolling over accounts is what you need to start doing. Pensions are not lifestyle funds. They are for retirement. When you get your gratuity, people, it's not time to buy the car of your dreams. That is your retirement money, because you won't eat your car in retirement. Okay? Leave that money in there and put it in another asset. Learn to invest your gratuities. Learn to invest your pension. And also not thinking about where you can have tax-free growth. It's important to be able to have tax-free growth and investment. Unit trusts, those things are tax-free. Okay? So where can you generate money that's tax-free or grow money that's tax-free or tax incentivized? Because, Vernon, the tax code is for investors. It's not for employees. Employees, they'll take your money. But for investors, they'll give you tax concessions. So that is your 30s. So tomorrow we're going to talk about age 40. And what are the things to look out for age 40? Age 30 is for the 20-year-olds getting towards this. So if you're 25 and above, and between 25 and 29, you want to look at what age 30 is, because that's where you're supposed to be. And if you're in your 30s, you want to assess yourself. Am I here yet? And what do I need to do to catch up? And now start to work out your financial goals in improving that. That, Vernon, is our investment planning matrix. We'll be talking about the 40s tomorrow. So people still tune in for your financial planning sessions.
Oil prices, copper prices, all behind the markets on Money FM.